because at the end of the day, nothing has changed. I mean, we're still in, like I said, this Keynesian hell where debt levels are spiraling and there's no way out. And eventually the world monetary system is going to reset into something a little more sound. And when that day comes, your physical gold and silver are going to be your best ally.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is Craig Hemke from tfmetalsreport.com. Craig, thank you so much for joining us today.
Elijah, it's always a pleasure. Thanks for the invitation.
All right. Well, ever since about September 7th or 8th, gold and silver have been on a downtrend. What is moving the price?
Well, it's a couple of different things, Elijah. We at TF Metals Report have been talking all year about price moving forward in a bit of a 3 steps forward, 2 steps back pattern. When we bottomed back in July, we thought that would be something that would take us to new highs for 2017. I had my eye on 1320. In fact, man, it might have been the last time you and I spoke, we talked about that. Instead, we got all the way through 1320, made it to 1360, as everybody was worried about North Korea back at the end of August, and then we had the budget impasse and the end of the fiscal year and the debt ceiling stuff that was coming up in September. There was a rush of speculators looking for that gold exposure on the COMEX. Open interest jumped and price jumped, and like I said, exceeded our expectations. And now we're in the 2 steps back part of the pattern, where all that speculator money is being flushed back out. We'll probably make another low here soon. We've been targeting this Friday as being an important day just because that's the latest iteration of the jobs number will come out on Friday. And one of the things we've been following on my site, Elijah, is a chart that Zero Hedge published that they found from Morgan Stanley. And Morgan Stanley had been accurately predicting the jobs number. It's like they unlocked the Pandora's box of the Bureau of Labor Statistics. And this chart was wonderful in terms of predicting what the jobs numbers will be for the last 2 or 3 BLS Fridays. Well, on that chart, they've been predicting a beat of expectations for this month. So putting it all back together, we saw this 2 steps back part of the pattern begin back in early September. And we're hoping that it's going to conclude, maybe Friday, during the day Friday, after the employment numbers, maybe early next week when China's Golden Week is over, all that kind of stuff. And then we'll move into the fourth quarter and move to one last 3 steps forward part of the pattern that takes us to new highs for the year and sets us up for 2018.
So why do you think the debt ceiling decision on September 7th had an impact on the precious metal prices?
Yeah, isn't that funny, Elijah? That was the thing that seemed to turn everything. The day it was announced on September the 7th, which was a Thursday, I mean, gold was kicking butt. It was up 1360. And all of a sudden, this headline comes across that Trump had struck a deal with Pelosi and Schumer. And they were going to eliminate the debt ceiling entirely, not only kick the can to the end of December, but then at that point, just get rid of it. And you know what? Everything changed. Now, that should be, in a traditional sense, a fundamental sense. If we were talking about just simply gold and physical gold, that would be a wonderful development, right, from a fundamental standpoint, because the U.S. is basically eliminating any sense of fiscal responsibility at this point. I mean, Trump can cut taxes. Hell, cut taxes to zero, Elijah. Who cares? The Fed, the Bank of Japan, and the ECB are just dying looking for stuff to monetize. The ECB's been complaining about not having enough stuff to buy with their QE program. And that's, to me, is all part of why the Fed is trying to sell some of their balance sheet, because they know the ECB is going to be the dupes that buy it. Nonetheless, that should have been a positive development fundamentally. But instead, in this HFT-driven world, that was driven, I guess, in a separate direction. Interest rates have spiked on that news. That's the one rational development. The 10-year Treasury has gone from 2.02% on September the 7th to now what, 235? I mean, that's a 15% move in yield from 2 up to 235, actually more than 15%. So the bond market sees the fiscal irresponsibility of this. But because it's been used as some kind of rationale that, oh, everything must be, that means the government's going to do this, that, and the other thing. Let's make the dollar go higher. Let's drive the dollar yen higher. That makes gold go down. It allows the banks to cover all of their shorts that they issued at the end of August and into early September, and price has instead retreated. But boy, that was a big news item. And that's something that I think a lot of folks missed with the trend change back in early September, is that if the U.S., I mean, it was kabuki theater, right, to have this debt ceiling debate, but at least it provided some semblance of responsibility, right? Well, at least we're aware that the debt, now they don't even care. It just doesn't even matter anymore. It's Keynesian hell that we're in, and it's not going to end well when it finally ends.
And what was your perspective on the Fed balance sheet normalization announcement, about a week and a half ago, and how that impacted precious metal prices?
Again, it's all about interest rates, Elijah, and the Fed thinks that that's a way of forcing up long rates. Well, long rates have gone up just because of people dumping bonds in anticipation, of this lack of fiscal responsibility, but they'll come back down. And in the end, the Fed liquidating $10 billion a month of their treasury portfolio, one is kind of a drop in the bucket, right? I mean, they've got $1.5 trillion in treasuries, or almost $2 trillion of treasuries on their balance sheet. So $10 billion a month is not very much. And actually, I think they're just doing their friends a favor. They're throwing a bone to Count Draghi over at the ECB, because they've been on record. I mean, of saying they're running out of stuff to buy. They almost own the entire German bond market, or more than 50%. They own almost the entire Eurozone corporate bond market. They want to keep doing their QE, but they don't have anything to buy. So at least if anything, they can buy $10 billion in treasuries from the Fed. So anyway, I think at the end of the day, I don't think that's going to have a massive net impact on interest rates. The gigantic move we've seen in the last 3 weeks is not due to that. It's just due to smart money recognizing that that important bit of news that came out on September 7th.
Now, regarding your talk about, how there's been 3 steps forward, 2 steps back in the precious metal markets, and that ending this week, it looks like we're going to start a new uptrend. What is your perspective on the stock market then? If precious metals are going to go higher now, do you see the stock market falling? What do you see happening?
No, I don't see the stock. I mean, we've heard these predictions about the stock market falling. I've had predictions over the years that I thought the stock market was due to fall. And every single time you see the Fed and the other major central banks intervene. They know how the game is played. They realize that if you can get the machines to continue to buy stocks, then everything's, just progresses along just nicely. How do you get the machines to keep buying stocks? Well, you press the VIX down, the volatility index, and it's down at the lowest levels we've seen in 25 years now. And you get the dollar yen to keep going up. Those are the 2 key inputs that the big machines, the HFT machines take. And when they see the VIX falling and the dollar yen rising, they buy stocks. And that's how the Fed manages a higher stock market. What's the Swiss National Bank, one of the largest owners of Apple and U.S. equities anywhere. I mean, everybody's benefiting from this. And I'll give you one more thing about why the stock market might go up or continue to go up. And I actually give credit on this one to my brother, of all people, who thinks it is, let's call it a corporate welfare program. I mean, there's a lot being made of the pension shortfalls in the U.S. and all these pension funds that are woefully underfunded, right, and near collapse. Well, the only way those pensions can even closely make back up their shortfall in targets of returns and funding for future, I mean, they've got to get returns on the money in those pension funds. Well, how the hell are they going to do that, Elijah, when the 10-year note is at 2.3%? And so one of the rationale for continuing to inflate, manipulate, and manage the stock market higher is to give some of these pension funds a chance, that are invested in equities. So then they might have a little better opportunity, a better chance of actually funding all the retirees in the future. So think about that, from that standpoint, how precarious that situation is. If that's actually the case, if that's about the only remaining game in town for these pension funds to inflate themselves and they're getting more heavily into equities, and the Fed is kind of helping things along. Well, what happens when the day comes that it does all end? Another interesting thing to think about. So at the end of the day, I think the government and the Fed, the other central banks, they know that they need to keep the stock market afloat. For that reason, for all the way down to, the Bernanke's beloved wealth effect. And so it's going to take a lot to break it down. And I don't see that catalyst at this point.
All right. And before we let you go, Craig, I was wondering if you could give our viewers some maybe some price points to look out for confirmation that, another uptrend has developed, the uptrend that you're seeing coming at the end of this week.
Well, we've been talking on my site for a couple weeks now about this regular washout of all of this spec money from both digital gold and digital silver on the COMEX. And that's currently happening. In gold, we were broken down through the 50-day moving average, and today we are breaking down through the 100-day moving average, ultimately looking to bounce somewhere down near the 200-day moving average, which is down around 1260. But boy, I don't think it's going to go. If you want to look on a longer-term chart, I don't think we're going to go any lower than where if you pull up a weekly chart, you'll see there's a 50-week, a 100-week, and a 200-week moving average. They're all down around, let's call it 1240. Anytime price has gotten anywhere near there in the last 18 months, that's where you want to be, I guess we'll call it an aggressive buyer. It's a trading opportunity. So if we do manage to get down that far, which would be a pretty bad week from here, that would be your spot. I think the 200-day probably holds. And then once we turn, watch price as it encounters those same moving averages on the upside, right? Silver is pulling back just like it has on several occasions this year. In fact, if you go back to July of last year, this is now the 7th occurrence of price getting above the 200-week moving average 1 week and then being immediately set upon and smashed back down the very following week. That's the 7th time it's happened, Elijah. But I'm sure that's perfectly natural. That there's nothing, any odd in that occurrence, of course. Anyway, every time it pulls back, it seems to want to find support around 16 to 1620, something like that. That would seem to be your spot again. In an uptrend, we want to watch that $17 level. That's the one that silver's got to get back above. So hopefully that's some information that can help.
Definitely. And once again, Craig Hemke, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Elijah, yeah, certainly. It's always a pleasure to visit with you. And I encourage everybody to check out tfmetalsreport.com. The best thing about the site, frankly, is the people that inhabit it. We are proud to say troll-free. There's a lot of people out there that like to come out and just simply bash the metals after all these years. And we instead are trying to maintain a positive attitude and help each other because at the end of the day, nothing has changed. I mean, we're still in, like I said, this Keynesian hell where debt levels are spiraling and there's no way out. And eventually the world monetary system is going to reset into something a little more sound. And when that day comes, your physical gold and silver are going to be your best ally. And so TF Metals Report, we talk about that on a daily basis, all these price changes we monitor for people that are still buying physical gold and silver. If you can save a few bucks because we were able to anticipate the price falling, hey, that's great. So I encourage everybody to check us out. Again, tfmetalsreport.com.
I always appreciate you coming on the show, Craig.
Elijah, thank you. Anytime.